Welcome everyone. Joining me today is Chris Welsh, our CFO, and we'll both take you through the presentation on our half-year results. I'll do a short introduction, and Chris will take us through the finance numbers, and I'll finish off with commercial and operation elements at the end. I thought it'd be quite useful, just as a reminder to people who are new to the Accrol story. I'll pick out a few highlights. Just to be really clear, the market that we compete in is supplying all the retailers and grocers in the UK. I did read somewhere that we were re-entering the away from home market. We're clearly not doing that. But one thing that has changed in the market over the last 4 or 5 years is the number of competitors that we have. So there are now there are 3 private label manufacturers in ourselves, Vepper and Sofidel. And we have about 90% of that particular market between the 3 of us. And then if I include Kimberly-Clark and Essity, that completes the total UK market of manufacturers of any size. And clearly now Accrol is a major player in that market. The private label sector is still continuing to grow. It's still taking market share from the brands. And we certainly don't see that slowing down. Certainly with the cost of living crisis, we're continuing to see our market grow very well indeed. We've seen some quite significant changes in the business. Our headcount over the last number of years on a like-for-like basis has dropped from just under 700 people, and on a like-for-like basis, we're now under 300. If I include the acquisitions, we've got employees today of just over 400 people. And I'll come to the cost of living and salary increases at the end. But with the investments that we've made in our organisation, we know we're now one of the lowest cost producers in the UK. We have some of the best service levels with the retailers, and we're also really pleased with the level of engagement that we now achieve with all of our employees as an organisation. And you can also see the level of improvement that we've seen, and this has been driven by the automation programme that we've completed. And if we look forward now on how much spare capacity we've got as a group, it's probably between 20 and 25% spare capacity. And ongoing capital as an organisation is between £3 to £4 million, so relatively modest going forward as a group. So the cash generation for the business as we look forward looks very strong indeed. So just as a summary of the first half of this year, you'll see there that the private label, as I said earlier, has continued to grow. We've continued to grow with that, and over this full year, we expect our volumes to continue to grow in line with our expectations. EBITDA was up again, up by 44%, driven by improved margins. Margins have returned back to pre-pandemic levels, and Chris will give more of a flavour of that in a moment. Revenues were down as expected. We've been proactive at going to the retailers. As we've seen our input costs drop, I know from my commercial experience that if you are proactive with the retailers on costs as they fall, you keep control over the margins, and that's really important to us as a group. But we've seen some significant wins in the first half, which will positively impact us in the second half and certainly into full year 25, which we're really pleased with as a group. And another area that we've been growing over the last couple of years is our own tertiary brands. And today they account for 20% of our total revenue. Net debt continues to fall. And again, Chris will give you a flavour of where that'll end at the end of this year. And we're also particularly pleased around our wet wipe sales, up again 33% in the half year. And we'll see some quite dramatic growth in our John Dale business over the next 18 months with known wins. So we're very pleased how that business has come into our organisation and the opportunities we've got. And then finally, as a bit of a summary, we've installed a pocket pack line into our facial tissue business and brought that volume that we were outsourcing outside of the UK into our UK operations. So I'll pass over to Chris, who'll take you through some of the financial numbers and some of the bridges. Over to you, Chris.
Thanks, Gareth. Good afternoon, everyone. Welcome to the session. Just a summary of the financial position. Starting off with revenue, as Gareth mentioned earlier, we've seen a step back in total revenue on a like-for-like comparison for the half year 23, where we saw around 120 million of revenue, stepping down to 100 million for the half year 24. Primarily that relates to an easing of inflationary pressure that the business saw coming through in late FY22 and throughout FY23, whereas we've seen our raw material prices ease, we've proactively engaged with our customers to manage their pricing down as well. But what that has meant is that as we've managed those commercials strongly, as pricing has eased, is that we've recovered our gross profit margins up to around the 27% mark versus 18% in the comparative period. And that brings us back in line with historic pre-pandemic, relatively normal levels of gross profit margin. At a profit level, at adjusted EBITDA, strong results for the business, returning in excess of 10 million for the half year 24, up some 44% versus the half year 23. That represented a strong EBITDA margin of in excess of 10% versus around 6% in the comparative. Touching on net debt, I've got a bridge that will split this out later, but pleased to say that the business continues to manage down its leverage with the gross numbers there of a 25.5 million net debt closing at the end of half year 24, down by 5 million for the comparative. A bridge demonstrating our profitability growth, moving from, as I mentioned earlier, just over 7 million for an adjusted EBITDA result for closing out the full year 23 through to 10.2 million for closing the first half of FY24. As Gareth mentioned, what we've seen is a step down in pricing, but that has largely been offset by volume growth wins and then allowed us to grow margins as paper costs and raw material costs have eased coming in, recovering those gross profit margins, and then strong cost control after that to deliver a successful 10.2 million EBITDA. Just stepping back a little bit and showing some of the overarching trends in the financial overview, wanted to demonstrate the compounded annual growth that we've seen coming through in revenue versus where the business has been over the last 5-year period, demonstrating an annual average growth rate of close to 5%, albeit acknowledging some step down in pricing from 23 into the first half of 22. And from an EBITDA perspective, just demonstrating the consistent growth in delivering strong EBITDA profit and drawing attention to a couple of key events around the business turnaround as a product of our strategic review, and then some challenges that we faced during the war in Ukraine event, where we were subject to significant inflationary pressure coming through the business. From a CapEx perspective, pleased to say that over the period 21 through to 23, the business successfully completed a 20 to 25 million investment into fully automating the core tissue business, as well as laying down some new production lines in our facilities. And that marked the end of the significant investment into the core tissue business. And what we now see looking ahead is that we return to more like sustaining levels of CapEx of around 3 to 4 million moving forward, which should further enhance our cash available for capital allocation decisions moving forward. Finally, just bridging out our net debt performance versus the closing of FY23, where we can see an improvement in net debt from 27 million down to 25.5 million for the closing half year. What that represented was a deleveraging of the business from around 1.7 times to 1.4 times. And what we're expecting to see in the business is a continuing trend that we've seen over the last couple of years as we head towards around 1 times levered for the closing of this year, FY24. In terms of usage of our cash, as we've touched on, strong generation on EBITDA. We've then had small levels of CapEx investment into production assets, like Gareth mentioned with our pocket pack machine earlier. And then we've seen some additional cash requirement coming through on our interest paid, as we've seen inflation pressures coming through and the corresponding increase in interest rates associated with that. As we look ahead and see inflation starting to ease, we do anticipate some easing of interest rates looking ahead, which again will drive further free cash flow for the business for capital allocation moving forward.
So just a few slides on our commercial performance and our operational performance. I'll just cover our markets. So just as a reminder, as I said earlier, we are and remain one of the biggest suppliers now to virtually every grocer, retailer, discounter in the UK. There's only one retailer of note that we don't supply, and very confident over the next 6 to 12 months we will rectify that one gap in our organisation. But one of the things that we've seen improving in our business and growing significantly is our tertiary brands. So we have our Elegance toilet roll range, our Magnum kitchen towel, our Softy facial tissue, and our Little Heroes wet wipe brands. All of them are in significant growth. All of these products give us a margin improvement, and we're seeing some fantastic growth areas across all of these parts of our business. It's an area that we see that will continue to grow, and I'll also touch on how this works with our licensed product in a moment. We've also continued to see some significant growth in our Oceans direct-to-consumer brand, and we use this route to market as almost a test bed for other products as well. So we've been trialing and testing the market with a laundry towel, which in effect replaces a laundry detergent product. And what we're able to gather from our 3,500 direct subscriptions that we have currently is the reaction from those consumers about their view of a particular product. So we find it incredibly useful, and it's something we're then able to scale and roll into the retailers. We're also really pleased with our John Dale wet wipe business. Again, we've seen a further 33% growth in our wet wipe business. Annualized sales in that business now is just over 8 million revenue, up from around £2 million when we first bought John Dale. And a new machine arrives in April, and we've got a very strong pipeline that we're very confident of growing that business to plus 30 million over the next 18 months via the retailer contacts that we've got. We also entered into a new agreement with another large consumer business, FMCG Group. This particular product will launch in March 24. We've deliberately not announced who the FMCG business is or the brand. And that's no more complicated than we don't want to give our competition a head start. But the reaction from the retailers, who have all signed non-disclosure agreements, has been absolutely fantastic. So we are very excited around this particular development for us. Expands the growth for the organisation into the consumer sector. And then something that perhaps some of you don't realise, but every 6 months, an independent organisation runs a survey for us to see how our customers feel that we are performing. And the last round of reaction gave Accrol a plus 8 out of 10 score. 8.25 was the actual result. Industry average is 7.75. And we have the highest score than any other tissue business in the UK. So we're particularly pleased with that. And that really is a reflection of the performance of the group as a whole in our service levels to the retailers. So as a reminder, all the capital investment in our business is now very much behind us. As I said earlier, the ongoing capital in the business is £3 to £4 million. We've seen a step up again in operational performance across all of our sites, with some highlights at Leyland. Our wet wipe business again has improved by almost 25% per head. The service levels in the business remain excellent. We are either number 1 or number 2 in all FMCG businesses that supply the retailers. And we're also particularly pleased again with our health and safety standards. We've gone over 3 years in our Flint site and almost 4 years in our Leicester site. Absenteeism remains exceptional. I've always believed less than 2% is world class, and our absenteeism levels are 1.3. And we also have independent retailer manufacturing audit scores, and all of our sites now are AA rated, which again, we are particularly pleased about. So there's a couple of slides on some of the investments that we've made. We thought it'd be really useful for people to understand, first of all, what hurdles we have for our investment program. What businesses do we look at? Why do we look at certain businesses? And highlighted here is just the John Dale organisation. And one of the things that we have realised probably over the last 18 months is that the most valuable thing that Accrol has is access now to virtually every retailer in the UK. And we know that we're able to scale businesses pretty quickly. And the John Dale business is a good example of that. As I said earlier, the revenue in wet wipes when we bought the business was around £2 million. Today, it's got a run rate of over 8, and we are very confident of delivering over 30 million pounds with a wet wipe business in a market that's valued at around 500 million in size. We are now really confident that we can grow our truly flushable, water industry approved wipe business to over 30 million pretty quickly. And we also give you some idea of what the return on investment was at LTC and our facial tissue business when we combine that with John Dale. So we wanted to share that, the sort of levels of how well we are using our money and what drives the organization and what the decisions are that we make to give us the right levels of return. So it sort of moves nicely onto Severn Delta. Severn Delta adds to our product range. Whilst they produce a wide range of different wipes, the areas that interested us the most was their disinfectant wipes. And we will roll their range of products again into our existing retailer portfolio. When we bought the business, the revenue was £5 million. The multiple we paid was just over 3 times. And the operational synergies that we expect to deliver for the business, which quite simply is just procurement benefits, and the cost of that business then drops to 1.5 times. We've not assumed any additional growth in our synergy numbers initially, but we've already very confident of doubling the size of this business very quickly indeed. Because of our, as I said, our link into the retailers, we've had a great deal of interest from a large number of them to increase our range of products that we'll supply into that group. So really excited about it. We expect the levels of return to be better than John Dale, and it's a business that we know we'll be able to integrate pretty quickly. So if I look forward into the rest of this year and into full year 25, we already upgraded our numbers in November of last year for this year, where we expected our EBITDA returns to be at least 21 million, revenues to be north of 200 million. And in this RNS, we also upgraded our full year 25 numbers to factor in the Severn Delta acquisition. We are clearly very pleased with the first half, but we also go into the second half with a lot of confidence. It started very well, continued strong margin growth in the organisation, and we can see an acceleration in our cash generation as our EBITDA continues to progress. So very excited about next year and at the end of this year. We will, in the short to medium term, return back to the dividend list. It's something that we and the board have been very keen that we look at. And as we get closer to that, we'll take guidance from our major shareholders. So look forward to this year and into full year 25 with a lot of confidence. And I'll stop there and open up for questions. I know there's a few already come in.
First question, how much of the spare capacity will the new deal with the FMCG customer utilise?
So the expectations are that we can see that part of our business growing pretty quickly. We've got some significant capacity available to us. We've always said that this part of our organisation should generate between 20 and 30 million pounds worth of revenue. We're pretty confident that with this new arrangement that will accelerate to there pretty quickly. The total capacity we've got available to ourselves, including wide reel manufacturing, probably equates to 70 or 80 million pounds in sterling terms. So it's going to be around about 30-40% of our available capacity.
And you talk of 3 to 4 million of capex expenditure, and you state 20% spare capacity. Some lines you're quoting 33% growth. At this rate, surely you'll require more capex as spare capacity reduces.
Well, one of the things that is positively impacting us, and the reality of our automation is we haven't fully experienced yet the full benefit of the automation program that we've completed. We did the final site in Leyland about 3 months ago, and the benefits of all of that automation is continuing to flow through to us. So we're very confident that any major capital in the organisation probably won't be required for the next 3 to 4 years because of our improvements in general as a business. So unless there is something significant change in the UK market, we're pretty sure that the level of capital required in the core business over the next 3 to 4 years is around £3 to £4 million. And in that capital program, we have assumed that there would be one more machine coming in. So we're confident that with the level of capacity we've got, the monies we've talked about are correct. And if it's not, then it's only a positive piece of news, to be honest. If we grow faster than we expect, then I'm quite sure that we as a board, we as an organisation, will be pleased to be investing quicker than we expected. It's certainly over the last 3 or 4 years, the business has grown between 6 to 8% on a volume basis. And we don't see any reason why we won't continue that growth. The market is continuing to grow. So we're really pleased with the position that the Accrol organisation is in. So,
please, can you comment on the proposed mill development, particularly timing, cost, and funding arrangements?
So it's going to be quite a short response on the mill, only because I am and Chris are in the middle of some final negotiations. The reason why there's not a detailed update on the mill is no more complicated than the most important element here at the moment is I get the negotiations of the final piece right. And what we won't do is publicly negotiate in a forum like this or in RNSs. I hope people understand that this is a very important part for the group, and we've still got some options available to us, and the individuals that we are discussing that with, we hope to conclude that in the next couple of months. Timings wise, it's exactly as we've previously described. So it's the middle of 2025 to the end of 2025 when this will be operational. The costs remain exactly the same as we've previously outlined to our shareholders and to forums like this. The timings haven't changed. The benefits to the group remain exactly the same. It makes a lot of sense to us as an organisation. And as soon as we've concluded the negotiations and we've got that bit right, we'll update the market. But we don't expect it to be a particularly long period from now until we conclude that final piece. But hopefully people understand that it's not a great negotiation to do it publicly.
And you've alluded to the dividend, but we have a question here. When will the dividend payment likely resume?
Well, I think we've talked in directly to our investors on a face-to-face basis and on forums like this that we want to do it in the short term. I believe that our brokers who write on us in Zeus and Shore Capital, that I think Shore have that in full year 25 as the year that they can see that the dividend would start to return, and we don't think that would be an inappropriate timescale.
And what's the trend on pulp pricing at the moment?
Well, pulp pricing, and just so people are, pulp pricing does not drive solely the tissue pricing, but I can cover pulp because it's an indices that's freely available or available to most people. So we've seen a softening of pulp pricing, certainly over the last 12 months. Although I would say, recently we've seen that decline slow and stop and stabilize. And we've seen pretty consistent tissue pricing over the last 6 to 8 months. And in our assumption, we believe that tissue prices will remain pretty static over the next 6 to 8 months, with further capacity coming on stream. So we don't expect to see large fluctuations in tissue pricing going forward. And we also would expect then, to see pulp prices being pretty stable as well.
And can you talk us through the integration of Severn Delta and the time frame?
So we've obviously owned Severn Delta for less than a month. We had a very detailed synergy program ready as and when the acquisition was completed. The second of those meetings literally is on Monday. The procurement synergies we expect to flow through pretty quickly. The business is already reporting into our normal structures. We have a very simplified, robust way that we manage our different sites, and Severn Delta will bolt into that pretty seamlessly. We expect to deliver the synergies pretty fast. Reaction from the retailers has been strong. As I said earlier, we've already got a piece of work that we feel that will go into that organisation pretty quickly. The business has a really strong management team running it on a day-to-day basis, and so we see it fitting into our organisation pretty quickly. Clearly, we've got big aspirations of how much we can grow that group. It's got quite significant capacity with additional shifts available to it, and some exceptionally good assets that we know we can scale. As I said earlier, we're already briefed all of our sales teams. They are in detailed discussions with retailers. We're aware that a number of organisations, retailers, are looking to bring a number of wet wipe sales back into the UK. A lot of wet wipes get manufactured in Israel and that region, and so there's a large number of retailers looking to move their wet wipe volume back into the UK, which we feel that we're in a really strong position with our John Dale offering, and now with Severn Delta we can benefit from. So we don't expect to take a long time. It's a relatively small business that can fit into our organisation quickly.
And with acquisitions, what's next?
Well, we look at a lot of businesses. I was asked this in one of the a number of the meetings with our shareholders. We don't rush. If we find the right business that adds sensibly onto the product range that we've got. What's wonderful about the Severn Delta business is that the buyers in all of the retailers that we work with also buy disinfectant wipes and the range of products that Severn Delta produce. So it's a really simple, easy bolt-on. It makes their life significantly easier. It adds more product range to us. We absolutely expect our core business of toilet roll and kitchen towel to continue to grow. We're in a really strong position. We continue to see the brands in the UK decline, and we don't see any real change in that market. Clearly, if the right business came along that made sense to us, then we've got the cash generation to act, and if that comes along, then we'll make that decision. But we're not an organisation that's rushing to buy the next organisation. But if the right one comes along, we'll do it.
And you discussed using a direct line to test new products with a large number of consumers. Are these testers individuals like families or retail organisations?
So no, it's so we have about 3,500 subscribers on our Oceans website, and what the organisation does is it selects a number of those with different products that we trial, get their initial reaction, get their thoughts about some ideas that we've got, and then we're able to take that data to the retailers and scale potentially that part of our business into the retailers that we already deal with, and you'll start to see our Oceans product going into some of the retailers. So there's a variety of ways of getting reaction. We know that level of data then is really powerful, and we're able to then share that with different key retailers that we deal with and grocers.
And have export markets been opened?
The easy answer to that is no, but it works both ways. Well, you can't ship in finished toilet roll in any great scale. and equally we can't ship out toilet roll to France or Germany. There is some of our sales, but we're not going to get too excited about. There is some of our sales of our wet wipe sales does go into mainland Europe now, but it's really small. And clearly we obviously supply Southern and Northern Ireland with our products, but that's purely through the distribution channels that existing UK retailers have. So export or import of toilet roll, kitchen towel is not something that we either worry about or think that is going to be a growth area for us, purely because of the value of the product in the first place.
What's the biggest threat to the business?
I think the biggest the biggest threat. I think the biggest threats to the business, in many ways, are behind us. If I go back 4 years when we had, 10 dozen small tissue business not dissimilar to Accrol at the time. Many of those have disappeared or have moved into markets that have gone elsewhere and are producing different things. There was a threat, I suppose, to the business then with regard to the sheer number of small independents there were. Today, with the rationalisation of the market, that is disappearing. There's a lot more sense around commercial control because of the fact there are 3 or 4 manufacturers in the UK. There's clearly a big opportunity. What happens to Kimberly-Clark? Where they progress. If I look at mainland Europe, the brands there have declined quite dramatically. What often happens when the market share of private label to brands hits 60%, you normally see an acceleration away from the brands increases. So if anything, I suppose the threat to us is around potentially how we would react to that. But we're in strategic relationships with the majority of our customers. We have discussions around this pretty regularly. So we'd like to think that we'd have some sight of that, and I suppose how we would react to that could be quite interesting. But I think that would be my biggest threat.
And can you talk about the new John Dale production line versus the existing lines and Severn Delta lines?
So the reason why we bought John Dale in the first place was it was already producing a water industry approved wet wipe, which is flushable. And the new machine that we have bought that goes operational in the John Dale business, again, it is a machine that will produce a flushable water industry approved wipe. It clearly is of a new generation compared to the existing one. Incredibly high speed with limited manning on the machine. So again, a very low cost producing line, capable of outputs of around 15 to 20 million pounds worth of product can flow down that, depending on clearly the value of it at the time. So it's transformational for John Dale in many ways, and the fact that the scale of the business changes quite dramatically. But we're very confident of filling that line pretty quickly. As I said earlier, there's a groundswell of a move with the retailers of onboarding manufacturing of wet wipes back into the UK, and clearly with our investment, we're in a really strong place to benefit from that. And again, the Severn Delta business has pretty new machines already in place that they haven't been manning on full shifts, certainly across 5 days a week, 3 shifts a day. And that's something that we know we can scale. Limited investment required in the Severn Delta business, but a great opportunity for us to flow their product range into our existing customer base.
And a question around client concentration. Can any one customer have a detrimental effect on the business if orders aren't forthcoming?
The answer is no. There's no one customer bigger than 20%, and that's remained in the organisation for some time. So despite our growth, we've been able to grow pretty consistently across a wide range of grocers and discounters. Over the last 12 to 18 months, we've seen bigger growth in the larger grocers that we supply in comparison to we were over indexed into the discounters, but that balance is starting to swing. So there's a real nice cross section of the big four retailers, grocers, and all of the discounters. I said at the onset, we've got one grocer that we don't deal with. Severn Delta adds some more businesses that we didn't deal with, which is good. And we'll continue to try and ensure that we supply everyone in the UK, and we certainly will ensure that there's no one retailer dominates us.
And why have administration costs been rising?
Yeah, no problem. I think just draw attention to a slight timing difference there in that we've had some costs come through this year that were slightly front-loaded versus the previous year. When I look out for the full year, I expect costs to be broadly flat and in line with last year.
And how do you see the opportunity to sell into the industrial market? So, for example, wet wipes for hospitals.
It's not a market that we intend to move into. We want to sell toilet roll and toilet roll into pubs and hotels, but only because they buy them mainly now from Lidl and Aldi, and clearly our position in the cash and carries is growing strongly. So we do expect to see our toilet rolls in pubs, restaurants, hotels, but it's more to do with the fact that a hell of a lot of those now buy them from the people that we supply. So and again, our cash and carry growth is been strong over the certainly the last 12 months. The away from home market is, or some people call it the out of home market, is not a market that we intend to go back into. We exited that 5 years ago, and it's certainly not a market that we intend to return to. The disinfectant wipes that Severn Delta produce will be sold into the grocers that I've described. So it's not a market that we envisage as going back into at all. So we won't be supplying them. It's probably the easiest way of describing it.
And that's the end of questions. Gareth, do you have any closing remarks?
No, I'd just like to thank everyone for joining. I really appreciate the time everyone's given. I'm conscious that it's a really exciting time for the group again. Very much an organisation that's now in a great position to continue to really kick on and grow over the next 18 to 24 months. And I appreciate the time people are given. And I'm really excited about the next passage for Accrol as a group. So thank you very much indeed for listening.